I just hit the record button. It is what time? 8:34. Awesome. We are Multifamily Masters live. We do this every 2 weeks. Our goal is to drop as much content, as much valuable information as possible. What is Multifamily Masters? We have 60, 70 meetups across the globe, international, super proud to say international. Myself and I have two of the, hold on, let me admit another couple people. I have two of the best business partners in the business, Mr. Feras Moussa, Mr. Powell Chee. Together, combined, we collectively own, manage, control 3,000 plus apartments, 60, 70 meetups across the globe. If you are interested in hosting a meetup, if you're interested in becoming a professional in your local market, reach out to myself, reach out to Bethany Smith, reach out to Feras or Powell, and we will interview you. We will get you set up. We will hold your hand when it comes to running a meetup. We will help you learn this business inside and out, et cetera, et cetera, et cetera. We do this Multifamily Masters live every 2 weeks. If you miss part of this, there will be a recording on our YouTube channel. If you are not a member of our Facebook group, get in the search bar at the top, type in multifamilymasters.com, join that Facebook group. I believe we're up to about 6,000 members or so. Our goal is to provide as much free content as possible. I already mentioned the YouTube channel, name multifamilymasters.com. We have a monthly newsletter, and we have a mastermind, which Leonie Tran, Bethany Smith helped me out with that. If you have any questions about that, definitely reach out to one of the two of them. We're here to help you learn, share, network, and grow this business because we want to hold you accountable, because we want to partner with you, plain and simple. With that being said, tonight we're going to have a Q&A session with myself, Feras, and Powell. Powell, feel free to go ahead and introduce yourself real quick. My name is Garrison, Gilbert, my hometown, Baltimore, Maryland. 21 years experience, full-time real estate, straight out of college. I know nothing but real estate. I'm not a very smart dude, so the little brain I do have, it's all real estate oriented. Take it away, pal.
Appreciate it. Thank you, Garrison. So I'm Powell Chee, live in Los Angeles, and started this group about 2.5 years ago. Started with about 8 people in this group, and certainly it grew out really fast since then. And in that 2.5 years, like Garrison mentioned, we've grown to 60 something chapters throughout the world now. And I don't know, we're over 10,000 people in terms of total membership of our different sites. And I live in LA, but all my investing is out of state. So I started investing in 2017 with a multifamily property in Indianapolis. It's a 40-unit building. After that, I JV'd one with a couple of friends and family. And after that, I syndicated, or was in the syndications, about 5 different syndications. And currently, right now, I'm under contract on a self-storage deal that I try to host a Friday afternoon sort of Facebook Live, where I can just talk about what goes on once you're under contract in a deal. So, I mean, I talk a lot about storage, but I just want to talk more specifically in general. Once you're under contract, what happens, right? Because I assume that, a decent amount of people want to find that out. Like as you go through the weeks, you have certain deadlines and everything that you need to get through. And so I like to do that on Friday afternoons. So look for me inside of the group. And let me see, it's in terms of, I guess that's probably about it. So Feras, how about you?
All right, hello everyone. My name is Feras Moussa. I have a company called Disrupt Equity. For us, I guess, we have properties throughout Texas and Georgia. Currently, we have about 1,500 units under ownership and management, and I'm hoping to sell a deal and hopefully pick up a deal or two. Today, I found out the bad news. We did not win one big deal that I was so sure we were going to win. So, but yeah, we're vertically integrated. We have our own in-house management company called Disrupt Management, which is also doing third-party management, and that's continuing to grow as well. And yeah, we look at A, B, C assets and kind of really happy to help give feedback in any way we can, right? So really today's meetup, right, Multifamily Masters, really we're here to talk about kind of the things that people want to know about, right? We've had guest speakers, we've done panels, done a little bit of everything, but usually most people, have that certain question, that certain thing that they want to know that they're maybe too shy to ask, too nervous to ask, or, it's kind of the thing that maybe people overlook teaching about, right? And so we figured we did one of these about 2 months back. It was really popular, and we figured, hey, we'll do it again, right? where really, you know, we're not here to run an agenda or a plan. We're here for you all. And so with that said, I mean, you know, for the next kind of 30, 45 minutes, right, we're just going to open this up, open mic, and let people ask any questions they want to know. And me, Powell, Garrison, or, you know, maybe any other expert in the audience that wants to answer, would be happy to let them answer. And so, you know, with that said, I'd say pretty much any questions fair game. For those that don't know me, I'm a pretty open book, pretty candid with my answers as well. So happy to kind of help with that. And so if anyone has questions, go ahead and plop them. Otherwise, I'm going to ask Powell a question. Powell, what did you dress up as for Halloween?
Ooh, unfortunately, I did not even dress up as Halloween for Halloween. So there was, I would say I dressed up as me. Really, there was nothing. Unfortunately, no little kids around and everything. So boring story, but wish I could say something awesome, but wasn't.
Dressed up as Mr. My family do that. Dressed up as The Incredibles. So we had that going.
Okay.
Yeah, you look good in that outfit, Feras.
Thanks. Are you saying my natural muscles aren't as good looking as the outfit muscles? Is that what you're
Next
trying to say?
Next question.
All right. So we do got a question. What creative financing deals have you done, from Miss Bethany Smith? I'll answer one. I mean, it's not really creative. We've done several bridge deals, right? And I think bridge has a lot of negative stigma, but honestly, we home run our bridge deals, right? Bridge is a tool, so using the right tool for the right job, right? Not everything, you know, not every nail and screw you hit with a hammer, right? And so used effectively, it's powerful. And so, I mean, we literally just finished a refinance from one of our bridge deals this past Friday. The whole process is a big headache in terms of that loan. That deal has always been a problem with lending for a lot of reasons. But we did that refi, and we got out at a really high valuation, and, you know, it's the right tool for the right job. And so to me, that's not very creative, but, you know, we are selling a deal right now. We're about to, and we know the people offering on it, and we're looking at, hey, how do we do something creative? Because we already know those people as sellers, right? Can we structure kind of a situation that gets us the price we want and also opens up some doors for them to be able to come up? So that's maybe my answer. Powell, Garrison, you guys have
I'll mention one right now. It's the one that I'm in right now, but it's not a big one, right? It's just, I don't know, it's a little over $500,000, right? So it's not a big one that I'm doing. It's not a big syndication or anything like that. But we're having all these issues with the financing side of it, and just kind of conventional financing, SBA financing. This is a self-storage unit, so you can do SBA lending. But we're having all these issues with it. Conventional, it's just a lot of friction. And I was like, okay, just running into all these problems. So I started thinking, well, we might have to go bridge pretty quickly here. We might have to start sourcing out some bridge lenders. And so I started talking and just trying to find out, what are bridge lenders doing right now, and how much are what are their rates, and things like that. But really quickly, I just kind of opened it up to a few investors that I know. And I just said, you know what, we're about to pay this much to a bridge lender. If you're interested, you could be our lender if you want, and we'll just have you do it. And then I had to just like an investor just say, you know what, I'll do that. If you're going to pay that to the bridge lender and you just rather just pay me and do that for like 3 or 4 years, I'll be your lender. And so that to me is like way easier than going bridge and getting all the forms done. And so, you know, this person's like cool with the property, likes it and everything. And so to me, it's just like a huge weight lifted off my shoulders, because now I can just kind of source out the best conventional financing that I can get, and not have to worry about, oh, I have to just take whatever, because I can always kind of fall back to this and just say, hey, this person's okay with just kind of doing the whole thing. So, so I think that's pretty awesome.
For me, it's been, I've been on the buyer side and the seller side of tons of seller financing deals. I like them. The biggest thing, it's all about listening and creating that win-win relationship, figuring out what that other person wants, and then creatively structuring something that puts them in a winning position or makes them feel like they're in a winning position. And it's not always about price. A lot of times it's about terms. It's about not paying taxes. It's all about having their family happy. A couple of the ones I did kind of recently, smaller mid-size apartment buildings, 30 units or so each. We built up some relationships with some probate attorneys, and the families we were able to give a better price, a little bit higher. We offered 0% financing, which sounds kind of ironic, but we offer 0% financing because then the price almost doesn't match or doesn't really matter so much. I can offer a price way up here at 0% versus a 5% that would be a little bit lower. So it made them happy, and it made myself and my investors and my business partners happy. So that's probably one or two of the better ones I've done was 0% seller financing.
Alrighty. Next question.
Hey, here's a question I had a little bit ago, Feras. Can I
Go
can I
for
bring
it.
this one up? Mike Hadris asked me, what do I think of luxury vinyl plank? He emailed it in a little bit ago. His specific question was, I'll let you guys answer it. His specific question was, do you like luxury vinyl plank on second, third, fourth floor apartments because of the noise underneath? I have a clear answer to that, but go ahead and take it.
I mean, I'd say my answer is it depends on the apartment. Some apartments, they got subfloor issues on the second one, and it becomes actually extremely expensive to do it, right? But if you can, I would, right? I mean, it's maybe my answer. It's a case-by-case basis, but usually most of our deals we do end up not doing it because we're buying 70s, 80s assets, right? So, but there's a 2004 bill that we looked at very closely, and they had already done it second floor, and it was amazing. I mean, you couldn't hear anything. So
Yeah.
that's maybe my answer.
Over the last couple of years, go ahead, Powell. I'm sorry.
I was just going to chime in on that too. And I'm going through that right now because on one of my sort of my property that's a C- class kind of property or in a C- neighborhood.
What city is that? What city is that?
Indianapolis.
Okay.
It goes through a ton of like turnover costs are really expensive, and that carpet just gets ruined almost every time. And in terms of costs right now, what I'm kind of like in the mode right now of changing some of the units from carpet to vinyl plank. It's costing me about $500 more in terms of just the flooring, but we can do $500 includes the bathroom, includes the kitchen, includes the utility room. So it's a little bit more material as well. And so I'm going to go try to do that for the next couple ones and see how that works out in terms of like durability, things like that. So to me, it's kind of worth it for $500. I figure I'd just do it.
And your turnover costs are almost zero. That'll pay for itself within one turnover. So you're good.
Yeah.
For me, I put luxury vinyl plank in every apartment building. The last probably 150 apartments or so that we bought were complete renovations. I mean, complete renovations, $20,000, $25,000 per unit. I put luxury plank in absolutely everything. I don't care what level it is, because of what Powell just said, turnover costs. And even in a multi-million-dollar house, estate that I just built, I put luxury vinyl plank throughout the entire house, all three levels. I like it a lot. Durability, awesome. Affordability, awesome. Looks, awesome. I'm not a fan of carpet at all anymore.
How much more would you say you priced out like carpet versus like doing the floor?
I haven't priced down carpet in a while, but luxury vinyl plank has costed me. I just literally I have a truckload coming right now. $331 a square foot for a higher grade. Something very nice. Normally for apartment grade, I buy about $1.99 a square foot. Yeah. Plus another $1 a square foot or so to install.
Okay.
Something like that. 80 cents, 70 cents, $1, 70 cents or so a square foot to install.
So, hey, Garrison, can you get your hammer and bring it along and meet me some of my properties, help fix our second floor issues?
Man, good luck.
All right, let's keep going then. If an apartment is currently operating at 55% occupancy, outdated, under market rents, would it be considered too risky to try and turn around, or what steps would you like to ensure the best chance of success? I would say the answer to that is in the eye of the beholder, right? We've done a deal that we bought that we started at 80%, we brought it down to 40% occupancy, deferred maintenance everywhere, and ultimately that deal start to finish, 18 months, we got our investors, I think about 75% return, right? 80%. So, but we learned a lot of things from that deal. And I'd say on any deep value add, think about how much CapEx you think you need and then multiply it by 2 and then add a little bit more, right? Like really have more reserves than you think you may have and know what you're doing, right? If you're going to do that kind of play, I did that kind of play because I knew that ultimately I didn't have to bet on anything going right except for us doing our job. Didn't need to worry about market conditions or any of that. We knew it was all there is ultimately getting things online, getting things turned around and cleaning up the property. So maybe that's maybe my short answer to that question. Garrison, Powell, you guys have anything to add to that?
No, I'm good.
All right, Garrison, I need you to get your crystal ball out. What do you see interest rates doing next year / post-vaccine?
Negative 10% everywhere across the board. Gotta be.
Yeah, I mean, let's actually Anton's on the call. You want to let Anton answer that one?
Yeah, realistically though, what I think it's going to stay right where it is right now. But Anton would definitely be the guy.
Yeah, that's kind of my thought. And I think, you know, we're here with low interest rates for a while. Anton, are you there? You want to answer that one briefly or no?
Well, you always ask me the questions no one knows the answers for.
Well, that's because I give you a chance to not, you know, you can't screw it up. Think of it that way.
Look, some of the smarter guys out there, Goldman Sachs, Morgan Stanley, the analysts, they predict anywhere from 20 basis points all the way up to 100 basis points an increase in the 10-year treasury. So post-election. So
speak English, Anton. Speak English.
So essentially, if the treasury yield goes up by 50 basis points or 0.5%, that means that your borrowing rate likely will go up by the same amount, right? So at least based on what Goldman Sachs and Morgan Stanley see, you actually have a risk of higher rates rather than lower rates.
Hey, Anton, and here's my thought on that. I don't really care how low or how high interest rates go, because cap rates are going to adjust accordingly, and I'm still getting the same cash flow. It does not matter. I guess more so I'm concerned about 10 years out when I'm trying to refi, right?
Well, certainly 10 years out is so far out, who knows, right? However, certainly your cap rates will adjust. If, let's say, the 10-year treasury yield moves up by 50 basis points, likely your cap rates need to adapt at some point, right? Unless there is such a massive demand and the delta between cap rates and the treasuries shrinks, possible, right? Because there is a lot of demand for multifamily, but we don't know, right? But if let's say the delta remains the same, your cap rate is going to move up proportionally, which means that the valuation will also be lower for the same NOI. So you better get higher NOI to compensate for the higher cap rate.
Yeah.
Keep going then.
What are interest rates right now, Anton, on a Fannie or Freddie type of program?
Yeah, I mean, it really depends a lot, right? On a large deal that qualifies for all the affordability discounts, for the green rewards, you can be, for a full leverage loan, you're still under 3%. Most loans do not qualify for everything. So I would say typically it's around the 3% to 3.3% mark. If you have a lower leverage large loan, it can be in the 2.5% range. For smaller loans like Freddie SBL and small Fannie, expect somewhere between 3.5 and the upper threes. And if it's in a tertiary market, really small market, it's likely 4% plus.
Yeah, so we closed our refi in San Antonio that we couldn't get any waivers from Fannie on at 3.29% on Friday. So yeah, all right, let's keep going. Sent a couple of questions to Garrison's email. Should I type in the chat? Yeah, Raymond, go ahead and type into the chat, or Garrison, if you want to look up the questions you got in the email, we can kind of talk about them, but I'll keep going. Has anyone purchased a condo building and converted to apartments or vice versa? Can you speak about how you did your underwriting and why it made sense? I don't think either of you guys have, right?
I tried to purchase one and I got nervous because I couldn't control the entire condo association.
Yeah, I'd say that's kind of a tricky or loaded question in a lot of ways. Just know if you're doing that, I mean, you typically go from having one survey, one loan, one tax kind of status, everything, to having, 50, 100. I know Jeff did a deal where it was individually deeded condos, right? That all got converted into a pseudo apartment. Right, Jeff? That's it here in Houston. That was kind of the story on that deal.
Yeah, but it was already prior to our ownership.
Yeah.
But we do have, we do have the individual titles to those. So those could be sold off individually.
Yep.
That's 150 out of 152 units. Yep. So there's 2 units that are still out there being owned by somebody else.
Yeah. So yeah, there's a lot of people, I've heard horror stories about it. So think, condo conversions aren't the walk in the park for those of you that are thinking about it. If it's your first time doing anything commercial, probably not the best place to start.
And also, as far as working with the lender, I've heard there is issues as far as if you wanted to start selling off the individual condos, that doesn't mean the money's coming to you. The lender, is going to hang on to that money for a while until you get to a certain point before they start freeing it up.
Yep.
So
No, it's just like buying a portfolio, right, with one loan. Right. There's
yeah,
a lot
exactly.
of gotchas around selling one of the properties and keeping the other one. We looked into that really closely on a portfolio that we were looking at.
Yeah.
Can I jump in here quickly?
Go for it.
Yeah. So obviously, if you have that plan, you really need to have your financing in place that supports that, right? So don't get a Fannie loan and then think, oh, now I'm going to sell them off one by one. So it needs to be planned ahead of time. Also, another aspect is once you start doing that, you are pregnant with that, right? So once you are in there and you sell 10 out of 100, you cannot just roll it back, right? So be ready that once you start that you go through the whole process, because if you stop in the middle, you have a nightmare at your hands, right? Also, I was on the other side. We actually, in 2008, 9 and 10, I was involved on the condominium side, ground up construction, and we sold some packages off to investors. The reality there is, in my view, if you buy condos, you need to have a massive discount compared to the equivalent on a single family home, because you're still exposed to all the HOAs in there. And particularly when you have a distressed market environment, you have to expect that a lot of the other owners are not able to pay the HOA fees, and the whole property just essentially goes downhill. So I would be very careful in buying condos in any property unless it's a complete bargain.
In 2008, 2009, I was involved with a big hedge fund down in New York City. And we built an apartment building, but it was set up as condo conversions. And I think this was 2009 in Washington, D.C. market. And that was an interesting market at the time because that market was untouched because it was all government. You didn't have the big recessionary trends that we did across all the other markets. And we ended up just keeping it as an apartment building. And I'm no longer involved with that hedge fund, but I have a feeling they still own it and it's still an apartment building, but it's legally zoned and potentially can be sold off as individual units, which is a nice option down the road.
All right. Let's keep going then. Has anyone done a master lease on a multifamily deal?
Nope.
Not me. Nope.
All right.
I've been offered it. Somebody asked me if I wanted to sell my property on a master lease. And I was like, no.
I tried to get into one.
Hey, Powell, why
The owner wouldn't do it.
Powell, why did you say no?
Truthfully, I just didn't understand it as much, and I was just like, it's too complicated at this point. Like at this point, I'm a seller, right? So not necessarily a buyer, right? So I don't need to have to come up with creative ways to do it. It's just like, if I want to sell it, I'm probably going to have more people want to buy it than I have to worry about, try to figure out a different way that's a little bit something that I don't understand. And you know what I mean? It just made it a little harder for me. So I was just like, no, if I'm going to sell it, I'd rather just sell it straight to a conventional buyer.
Okay, got it. Thank you.
It typically, if you're going to do it, if you're having trouble getting the price that you want to push it a little bit. If you could get your price and totally sell it, then you might as well. But if you want to get a higher price than the market's letting you, then you could. A master lease is a way of trying to work that around. But it is more complicated.
Hey, Feras, I have these couple questions from Raymond. Would you like me to go ahead and read these off?
Yeah, go for it.
So let's start. He has three, it looks like three questions here. Number one, I have questions about financing the other part of the equity stack. The 25 to 35% after the primary loan. There are private equity firms that claim to be willing to invest in real estate stack for equity in the deal. Do you have experience with these sorts of companies? Number one, what are the pros and cons of these companies? Number two, so it sounds like he's looking to try to raise his 25 to 35% down, right?
So let me go ahead and answer that. So, right, the way debt works in multifamily, you have, you're buying an asset. Let's just say you're buying a $20 million asset. Typically, you get what's called a senior loan, right? That's going to go up to 75%, maybe 80%, right? So in my example, if you're doing a $20 million loan, maybe you get a $16 million loan, right? Best case scenario. Let's ignore all closing costs and fees and all the other stuff. But $16 million, you still need to come up with $4 million to close. Right now, there are essentially there's many different ways to do that, right? So we syndicate that equity, right? That rest of the slug, we raise it with our investors, $100, $200, $300, $400,000 at a time, right? Now, people do get essentially what's called mezzanine debt, right? Mezzanine debt is essentially another loan that sits on top of the senior loan, right? It is subordinate to the senior loan, meaning the senior loan is the senior loan, right? Things go haywire, that's the senior gets kind of first claim to get paid back. And then the mezzanine gets next rights, right? So the mezzanine is sitting think of it, it's sitting on top of the senior, but below the rest of the equity, whatever that is. So let's keep going on the example. You brought $16 million senior loan, you did a $2 million mezzanine component, right? Now you have $2 million left. And then maybe you syndicate that. So now as a syndicator, you're raising half as much. Usually your mezzanine debt is 5, 10%, right? I mean, not 5, so it's more closer to the 10, but it's kind of in that range in terms of what they want. And sometimes it's all for negotiation, but sometimes they want, just a specific interest rate. Sometimes you have what's called preferred equity, right? Which is a different way to do it, which essentially it's another equity group that sits subordinate, kind of they sit behind the senior, right? But they sit in front of your equity group. And so to keep going on the example, let's say, the deal doesn't work out for some reason, right? And you guys sell it for $17 million. And let's say you brought $2 million of preferred equity. What happens, right? Usually you pay back the senior loan, they get the $16 million. Then the preferred equity group that put $2 million in, they're getting $1 million out of it. They lost $1 million, but then the rest of the equity stack lost the rest, right? And so those are kind of the two biggest ones. It's all up for negotiation. People syndicate different types of classes, right? Where they have certain class that'll basically come in essentially like mezzanine debt, another class that'll come in where it's actually sharing the upside. And so read your company agreements, right? All this needs to be outlined. And another thing to kind of be aware of too is, mezzanine and even kind of some of the other creative structures is not allowed by all lenders, right? So I think mezzanine is only allowed by Freddie, for example. You cannot do mezzanine with Fannie, right, Anton? I'm pretty sure that's true. And so kind of be aware of that. That's maybe some of the.
Well, actually, you can as long as it's approved, right? So you have very, very tight levels where you can or cannot do it.
I've seen some of those groups that come to us and say they will only do it if it's a Freddie because they know they're not going to qualify for Fannie, right? So. All right. What's the next question, Anton?
Hold on 1 second here. I'm admitting a couple people into the waiting room. Part 2 of that question is, also there are companies that are capital raisers. What are the pros and cons of using a capital raising company?
Now that is a very complex question. Let's just kind of say that there's a lot of rules that you need to follow the SEC, right? Usually that company needs to have what's called a broker-dealer license, right? Where they can get paid to raise equity. I know there's some kind of changes in the law that should get passed from talking to every lawyer, but essentially what that law is going to change, right? It's not just going to solve everything, right? It really means that you can pay, for example, if someone wants to raise just equity, they don't want to be super involved in the deal, I can pay them for that. But I'm not allowed to give them a piece of the GP, right? I cannot give them equity in the deal. That's what the law is going to allow if it gets passed, right? But there are third-party companies that'll do it. There's a lot of rules you need to follow around. Is it a 506B? Is it 506C? How's that company getting compensated? What's their participation? I'm not a lawyer. Please don't make important decisions, and please go talk to a lawyer about the group you're talking about and what they're structuring and how they're going to follow that. So,
last part of that question. Lastly is corporate credit. Are there companies you use to obtain corporate credit? Fund and Grow can get between $50,000 and $200,000 within a year for a fee of $4,000. I think these are credit cards. Are there other programs that can do this? Question mark. Which are they? Question mark. Is it true that banks will give lines of credit after they see cash flowing in and out of an account for 6 to 12 months?
Anyone else know the question? I'm curious, actually. Who has corporate lines of credit, and how did you get them? Because that's actually something I'm wondering too.
I have some really good corporate lines of credit, and believe it or not, they're through American Express. Not American Express, the credit card, but American Express business lines of credit. Like right now, I have a $250,000 line of credit that is good for 90 days at roughly, if I go 30 days with it, it's like 2%, 60 days with it, it's 3.5%, 90 days with it, it might be 4.5%, something like that. I don't remember.
Is that 4% of the amount or 4% annualized?
4%. I think it's 4% annualized. I haven't used them in a while. It's pretty cheap, but the problem is it's only 90 days. And if you go over those 90 days, they will either shut you down or the limit, the interest rates go up to like 18%, something along a credit card. So I have a couple of those, and I've been hooked up with Wells Fargo of all places. We're considered high net wealth clients at Wells Fargo. We have a personal business banker there. And we've gotten a couple $1 million lines of credit through Wells Fargo, number one. And number two, every LLC or company that we set up, we go and we open up a Wells Fargo bank account. And immediately they give us a $5,000 or $10,000. Well, before the pandemic, at least. I don't know if things have changed. But before the pandemic, we would get $5,000 to $10,000 line of credit on a credit card, not associated with your social security number, just straight business credit card, right off the bat from day one. And then that thing would get, the levels would increase pretty dramatically over the next 6 to 12 months, as long as you continuously use it, pay it down, use it, pay it down, etc. Right now, I am using a gentleman, and if you shoot me a PM, I can send you over his number. I use one of my multifamily coaching students is a credit specialist. His name's Alvin. I'm trying to get my credit back on track, not because I have bad credit. I just don't use my credit anymore since I'm not in the single family space. I have like a 736 credit score because I just don't use it. I'm trying to get that up to 800, and he's working on business lines of credit. He will do things like that, and I think he will work off of a percentage. I know companies that do what you just described of getting $50,000 to $200,000, they charge you a $4,000 fee. I've done that in the past. The problem with those companies are, my opinion is, at least a couple companies I've checked into, it's BS lines of credit. It's lines of credit that you're never going to want to use. It's like, for example, not even Home Depot, just something crazy like, I don't even know if they're around anymore, like Model Sports. You might get like a $15,000 line of credit and it'll keep gradually getting increased. But what the hell are you going to use it for? But then you take that credit rating and your Dun & Bradstreet number, and then you go and apply for other lines of credit, and that should help you out a little bit. But if you have more questions on that, I can hook you up with my guy, Alvin. I don't know if he's on this call right now, but he's my credit guy that I would refer all of these to. So that's my 2 cents.
All right.
Yeah, I mean, like I would say that like I've gotten a business line of credit on a business, not necessarily like tied to my real estate. It is, but I had to have that business up and running for 2 years, right? You have to show your tax returns and things like that. And so that's with US Bank. And they gave me a decent line of credit. So they could have gave me up to like 75,000 or so, but it's 6%. And it's not any terms. There's no timeline on it. So it's just 6% that I pay on it.
You know,
so I use that one.
A little extra note on this topic. It's been a while since I've really looked into this, but back when I was in the single family space, at one point in time, I bought and sold probably 1,200 houses. I used to own the largest wholesale company in Maryland. And back then I had to do everything I could do. I played with my credit, my girlfriend's credit, my mother's credit. I did what I had to do to hustle. And what I was going to say is I just dropped that thought process. I'll get back to that in a minute. I don't even remember where I was going with that.
All right, let's keep going. I know there's a ton of more questions. So let's see, Powell, this one's for you. Keep it short, please. How do you ensure private lending is up to standard? Do you typically have an attorney to draft a contract between you two? And Garrison, do you buy them in bulk in advance? I guess.
Why are my questions I got to keep short, huh, Feras? Why is it my questions I got to keep short? But you're good.
Uh-huh.
I see how it is.
Hey, I answered the ones early on where we had time.
No, just in terms of, I think it was Harry, when you're talking about private lending, yes, you're going to want to do it, you're going to want to do it with a lawyer, right? You're going to want to make sure, like, you got to take care of your investors. You're not trying to like pull a fast one on them and like, oh, I got them to, to fund me. It's like, no, you want to protect them because you want to do it right, because you want to have a good relationship with them and you want to do more business with them in the future. And you want to, you just want to operate that way. So yes, you want to do it through a lawyer. You want to have them draft the note. And you just want to make sure that it's the terms are the right terms that you said that are going to happen with your investor.
All right, let's keep going then. Erin, how's it going? She said, did a JV deal with 3 other partners where I had to bring $300,000 to the table to grant me 25% ownership. I ended up getting 3 debt partners and tied them to 3 of my free and clear single family properties. I offered them 7% interest only, quarterly payouts, 3 years maximum loan, other people's money, 25% ownership, 35 unit, no money equals winner. Yeah, so basically she collateralized it with other assets, right, to get their money that she paid them less than she was making, right? That's kind of the way to get creative. So I like it. Let's see. All right, well, here's kind of the same question about the financing, the 25%. So I'll skip that one. We spent a lot of time on that. Anything specific or important to consider when evaluating self-storage opportunities? Any difference or specific documentation to request for due diligence? All right, that question is probably a good one for Garrison. Garrison, no, I'm kidding. I'll go for it. Self-storage here. That's why I was like.
I'll just tell you, so Matt, like specifically, you have to look at, like, the major thing you need to look at is the competition levels. So the competition levels in self-storage are like one of those factors that you really have to hone in on. So you need to look at your square footage per person in a certain radius. So like a 3-mile radius or a 5-mile radius, you need to look at square foot per person in that radius. And there's kind of like national levels where you say like anything below 7.5-ish is considered undersupplied. Anything over 7.5 is considered, oversupplied. So yeah, you can check those numbers out, but that's specifically a number you're going to want to look at, because you could find a great opportunity off market and all this kind of direct to seller, all this kind of stuff. But truthfully, if there's a big public storage next door, or if there's a life storage, just down the street, you could face some real tough competition. So that's probably the major thing.
All right, then let's keep going. Sridhar asks, any wholesale material suppliers and GC recommendations for Dallas? Yeah, there's plenty. I'd say go ahead and send me an email, Sridhar, and I'll point you at some. Let's keep going then. Any advice for how to take down a 20+ unit, $1 million deal? I currently own 14 units and am looking to take the next step up. The advice is, yeah, I mean, it's if you can't do it yourself with just your money, right, you need to figure out how you start looping in other people's money, right? And so whether that's syndication, whether that's finding other partners, JVing, right, that's what networking is about. That's what Multifamily Masters is about, right? Meeting other people, helping kind of accomplish goals. And so, yeah, and I guess your next comment is specifically looking to do either syndication or JV. Yeah, it's ultimately have a business plan, underwrite your numbers, make sure you can do it, and perform for people, right? Let's keep going then. I used a line of credit strategy to open my restaurant 5 years ago. All right, perfect. All right, well, I'm surprised. I thought we had a lot more. There's a lot of comments. I guess I thought a lot of questions. That's why we're kind of rushing. All right, Garrison, did you have any more questions from that email that you want to read out? No. If anyone has any more questions, go ahead and ask them, and we'll answer them. There's still time.
Don't have any more questions from that email, but one thing I wanted to mention with those lines of credit, whenever you do go get lines of credit for your business, there's a couple things you want to avoid with your name. Typically, you don't want the word real estate, equity, investment, invest, capital, money, equity, none of that type of stuff, because typically they don't want to give lines of credit to investors, people that are going to take that money and play with it. Just something to keep in mind whenever you name your company or name your LLC in your website. And Feras, do you want to do a breakout room right now?
Here, actually, we've got one more question. Let's do 5 more minutes questions. I want to just do breakout rooms and we'll call it a wrap. Is that good?
Okay. Yep.
All right. Here's a question that was sent directly to me, so I won't read out the person. What is the average IRR? And if anyone has any questions, they don't want me to read their name, I won't. Just send it to me direct message. What is the average IRR and ARR you guys look for in the current market? What underwriting do you guys charge for both acquisition fees and asset management, or just one or the other? All right, good question. So everyone's looking for different things. Ultimately, we're looking for 12.5% to 18% IRR, depending on the vintage and location of the deal, right? We'll take 12.5 if it's a rock solid deal in a great location, newer asset. We need better, more for better later. ARR, right? Ultimately, we're looking for kind of in that 15 to 20% annual, all in, right? Is kind of what we look for. So that's that. And then I think about the fees. Again, read your company agreement. Everyone does things differently, right? We're very fee light. We don't charge a billion fees. But we for acquisition fee and asset management, those are very different roles. I've never seen one person charge one or the other. Usually it's both. So we charge both, right? Acquisition is very different than the day-to-day operations, which is asset management.
Yeah, I would say for us, we're pretty similar. Anything above 15% IRR, so we're looking at, and you're looking at like 16 and above % average annual return. I mean, for me, typically nowadays, I'm really just looking to JV with people. So I'm not really trying to put together a syndication. So most of my network is people that are interested in investing, but want to get involved, specifically to get more experience and to be involved in the property and to learn the whole time. And typically they have some capital as well. And so that's who my general investors are. And then I just form a small group of partnership, with those people. And then we go take down probably a smaller deal. Obviously, we're not syndicating it, so we're going to take on a smaller deal, but something that we think is good.
All right, let's keep going then. When a person do a deal with someone, how do you vet who you partner with on deals? Which is the best way? Good question. It's about networking, getting to know people, ask them who they've done deals with. I mean, I honestly wouldn't do a deal with someone that I just don't know at all and nobody knows them. Right? To me personally, right, most of the time you're playing with big numbers, a lot of other people's money as well. Your reputation's on the line. Don't take that risk, right? Get to know somebody, right? And maybe it's not, hey, let's, I barely know you. Let's not do a deal now. Let's date a little bit, right? Get to know the person before you marry them. And so, it's ultimately about learn. And it's not to say that the person has to have a ton of experience, right? Ultimately, if you're going in knowing, okay, this person is newer, this is the role they're going to fill, that's okay, right? We've done that. But ultimately, get to know the person, get to know who knows them, and see if anyone has experience with them, right?
Or keep them in a very limited capacity right off the bat. Yeah. Don't give them too much authority until you get to know one another.
And truthfully, like, I would say that I would probably approach people earlier than you think the deal is going to happen. In other words, saying that is like, don't approach them when either you have a deal or you think they have a deal and you want to get in on that deal, because there's sort of a time crunch that happens at that particular point, and people are kind of like putting things together and things need to happen really fast. So if you're looking to partner with somebody, so if I'm looking to partner with Feras or Garrison, I'm going to want to send them a deal and say, this is a deal that I like, and here's my underwriting, and this is what I think is good. I'd like you to take a look and tell me if you underwrote it, what would you say? What would you think about this deal, right? And then it's a lot of back and forth, and there's time where now you get back and forth, you can talk to each other about it. Oh, I like the value add, or there's not enough value add, or I don't like the area. Then you can get an idea of what the person's like. You get an idea of how you communicate. You also get sort of the experience of going back and forth with that person, right? Because that's what you're going to want to have, is that back and forth. Because you don't want to just jump into a deal and you guys haven't even discussed like your underwriting and kind of gone through like 5 or 6 different deals and figured out what you like in terms of your underwriting, what you're looking for, right? And as you have those conversations, you're going to have a better idea of whether or not you really want to work with this person. Are they on the same pace that you are? Are they going to work as hard as you are? Maybe not. Or they might work more than you. So sometimes you just gotta get that feel. You got to have that sort of trial period of when there's nothing really on the line. And then I would say, truthfully, you need to ask a lot of questions. Like if you're going to get involved in a deal and you're pretty sure this is going to happen, you need to start asking a lot of the tough questions when there is no deal out there, right? So when there's no deal out there, you need to start asking tough questions. And I've partnered with a lot of general partners before, and like some of the questions that you need to ask, I'll just give you like one. It's like if you're going to come in and you're going to say, hey, I'm going My value is that I'm going to come in on the early due diligence side and help you kind of underwrite, but I'm really going to raise I'm going to raise capital. I want to be involved in the operations, but primarily I'm going to be able to raise a lot of capital for you guys, right? You're going to want to know something like, okay, is the if I bring an investor on and you know that investor too, how do I know that investor, that I'm credited for bringing this investor on, or is it that you're credited just because like, how do we know? We both know the same person, right? That's a conversation you're going to need to have, because that's going to come up, because you and that other general partner or whoever probably know a lot of the same people. And so what happens in that case, right? And you're going to want to know tougher questions, right? Like what happens if, there's kind of things that fall through, like what happens then, right? There's no great answer for some of these, for some questions, but you want to hear what the other person has to say, right?
Sorry, I was
Sorry,
muted. All right, let's keep going.
Too long there. Sorry.
No, sorry, I didn't realize I was muted. James asked, have you ever purchased a partnership interest in a deal or sold one? No, I've heard of people that have, and the advice is typically don't buy an interest in another person's deal, right? Mostly because if you're coming in to operate the deal, you don't know what deals that they have struck. Those are technically legally binding deals, right? And so, for example, I might have struck a side deal with Powell saying, hey, Powell, we're just going to give you $5,000 a month for, just being available to answer questions. And, let's say we sign a 10-year lease, right? A 10-year deal. Well, you're kind of responsible for that. And if a person didn't disclose that, you're kind of stuck. So, I mean, it's not to say people don't do it. It's not to say you should never do it. Just know that going in that, from kind of what I heard, there's some risk there. Amanda asks, question for Feras. A couple of weeks ago, you mentioned a fast calc for preliminary underwriting, rent per/price per door. Which rent are you looking at, current or projected after value add? Good question. Really what I'm looking at is, ultimately I'm looking for a value add deal. I could care less what they're charging today, right? I need to obviously make sure I'm not overpaying for the asset, but ultimately that deal is going to underwrite on where I think I can take it to, right? And so I do a lot of times look at where it is today, because I don't think that a deal where they're getting $600 rent today that I'm going to be able to get $2,000 tomorrow, right? Usually I'm getting a feel for where they're at, and I'm trying to get a feel for where they're taking it to, right? Or the problem with your question, or maybe not the question, sorry, the problem with the answer to your question is that to get the projected rents, it takes a lot of work. I can't back a napkin that, right? But I usually start with where the deal is today. And I say, you know what, maybe I can get $50, maybe I get 100, maybe I get 200, right? Most value add deals, you're not getting more than $200 premiums, right? Best case scenario, let's say it is 200. So if the broker tells me, hey, this deal, they want $130,000 a unit, right? And he says, oh, the in-place rents today is $950. I'm like, okay, to get to $1,300 rents, that's a $350 jump. It's very, very not likely that a deal is going to get me that kind of premium. So I know that deal is not going to work. But if that broker says, hey, it's $130,000 a unit, it's kind of the whisper, and today it's getting $1,200 rents, and they want $130,000, so there's a $100 gap, I might take a closer look at that, right? $100, that's maybe achievable. I need to dig in more, right? That's maybe the answer to that. And let's do 2 more questions and let's call it a wrap. Then we'll do jump out to breakout rooms. Let's see. Is there a type of property you recommend for first acquisition? Minimum or max unit size, urban or rural, local versus long distance, value add versus fully operating? Powell, you want to answer that one, or Garrison? One of you guys? I've answered a lot.
This is one of those, it depends kind of thing, right? There's so many different factors there, right? Because it's really hard to say, Matt, because what your background is could be totally different than mine, right? And so it's hard to give you a full recommendation just for everybody of like what to do. I would say though, just to give you, maybe it's just help when it's coming to purchasing your first one. What I did was really just kind of knowing how much money do I have that I can put towards a down payment, and then how much money do I have to use towards CapEx, right? And knowing how much you have can give you the range of what you can buy, right? So then now you can look at, like, if you have $200,000 and you can use that full $200,000, you're looking at something that's probably around $600,000 to buy, right? Just kind of knowing what you're gonna have to come in with, at least 20% down on the down payment, and then plus some CapEx, right? So you just kind of, that helped me instead of, so where I was like, okay, if I have this much money, this is the range I'm looking at. Instead of looking at, hey, am I looking at a $3 million property? Or am I looking at this 200 unit property? Or am I looking at a fourplex, right? You know, you're look all this range of stuff, really just knowing the numbers of what you have in your first one. I don't, that helped me a lot with getting, narrowing that down. So hopefully that helps.
Okay, if I add a point in here. The one thing that I would say though, as far as you want a cash flowing property. First time out, don't get something that you're looking at the value adds and you're saying, okay, we're gonna, bring up a property that's not performing. I recommend that you get a property that is performing, maybe not at the level that you think it could be, and that way you can bring value to it and do that. But we've gotten a 30 unit or a property that was 30% occupied, and those are a lot of work. You don't want to do something like that one on your first time out. Get something that's performing that you can add some value to and go from there.
Garrison?
Well, that said, let's do one last question. We'll call it a wrap. What is a useful and compelling role I can play as a newbie to get involved in a JV deal? All right, that's the $1 million question. A lot of people ask that question. There's a lot of ways to get involved, right? I'm just going to start brain dumping them, and Powell, Garrison, feel free to add. But ways people can get involved in a JV. Bring a deal. Someone has a deal, they bring it to me. I'm more than happy to figure out a way to get that person in the deal and give them, reward for that. Another one, sourcing equity. That's very popular, right? Now there's a lot of rules with that, but that's a very common way. Being boots on the ground, helping operating a deal, helping do construction management. There's a lot of different ways to do it. And, that's basically maybe my 2 cents on ways for people to get involved. Let me say goodnight to my daughter. You guys can continue.
Yeah, I mean, sort of like Feras said, like really on there's the front end, the acquisition side, right? If you find a deal, if you're boots on the ground in the area that somebody is operating remotely and they could use you as boots on the ground, that might be something. If you can source capital, like you said, that's a great thing. And then, I mean, those are, I would say, the two main things is really coming in on the acquisition side or the capital side.
All right. Well, with that said, Garrison, you want to go ahead and let's kick it out and kind of wrap it up and just go to breakout rooms?
Breakout rooms in about 60 seconds. We are multifamilymasters.com. If you're not a member of our Facebook group, multifamilymasters.com, 6,000 members. Mastermind group. If you want to learn, share, network, and grow, reach out to Leonie, Bethany, myself, Feras, or Powell. We want you to learn this business because we want to partner with you. We want to hold you accountable. We want you to know the ins and outs. Interested in hosting a meetup? 70 plus meetups across the globe. We will hold your hand. We will give you all the tools necessary if you want to become an expert in your local market. So breakout rooms will last for about 5-7 minutes. I'm going to bring everyone back to this room. I'm going to keep this room open. So anyone that wants to stay